Hey guys, Adam Burns here. Let's bring it today on financing options. Now some of you might already know, but there's various options available from lender to lender, and every one of those lenders is going to offer you something a little bit different. So it's vitally important when you're going through the loan process to go out there and shop your rates and shop your terms. Talk to as many lenders as you can and find out what's going to be best for you. Today, for the sake of this episode, I'm going to break things down into 3 different categories of loans for discussion purposes. So the 3 that we'll talk about today will be conventional, government insured, and commercial financing. Let's talk about conventional financing first. Conventional loans come in 2 different types, either conforming or non-conforming. Conforming loans fall within a certain set of guidelines, and non-conforming fall outside of those guidelines. The guidelines are typically related to loan balance or loan size and other terms such as the amount of commercial space in the building or the amount of owner occupancy. Either way, conventional financing can be used for the purchase of either a primary residence or a vacation home. So as I mentioned, one of the reasons why a loan might be non-conforming is because it's just too large. These are referred to as jumbo loans anytime you fall outside of the guidelines of the loan maximums. Now, if you were to buy a house in most of the United States, the maximum amount of loan that you could take to still be conforming would be $548,250. In certain high-cost areas, that loan maximum actually goes up to $822,375. So, if your loan amount is below these, well, now you're conventional and conforming. If you purchase a house that's more expensive and your loan falls outside of these guidelines, well, you're non-conforming at that point. Much like other types of investment vehicles, mortgage loans can actually be bought and sold in what's referred to as the secondary mortgage market. In this market, typically what's bought and sold is conventional conforming loans like we just talked about. Non-conforming can also be bought and sold, but it just doesn't happen quite as often. Now, the greatest consumer of mortgage loans from the secondary market, you might have actually heard of, Fannie Mae and Freddie Mac. These 2 agencies purchase most of the loans that show up in the secondary mortgage market. Now, there's a whole complex system going on behind the scenes here, and we'd love to cover it in a future episode. So if you have interest, drop us a comment below and let us know. As I mentioned, non-conforming loans don't typically get sold on the secondary mortgage market. So what happens with these loans? Well, lenders that issue non-conforming loans typically keep them on their books and benefit from the interest payments that you're making. Lenders that do this are said to have what's called a portfolio loan program and keep the loans so that they can benefit from the future cash flows. We touched on this in another episode, but just a friendly reminder and a side note that if you put down less than 20% on a conventional loan, then you're going to be paying PMI or primary mortgage insurance. So keep that in mind when you're shopping for your loans, that there will be this additional cost when you go conventional and you put down less than 20%. The second type of loan that we're going to touch on today is government insured loans. These loans are only for your primary residence. They typically carry a low down payment, which is really beneficial for you as the consumer, but it is riskier for the lender, hence the government guarantee. 3 different government agencies actually back these loans. They are FHA, USDA, and VA. FHA loans allow borrowers to put down as little as 3.5%. These loans can also allow you to roll in some construction proceeds so you can renovate the property that you're buying. These are also allowed to be used on multifamily properties, so if you're trying to get your start in real estate, this is a great option. If you want to hear more about this, go back to the previous episode we did on getting your start in real estate and buying your first investment property. As another side note about mortgage insurance, keep in mind that if you're putting down less than 10% on an FHA loan, you're going to pay PMI. This adds to the cost of the loan, so make sure you're keeping it in mind as you're searching. USDA loans allow borrowers with low income to purchase in rural areas specified as USDA eligible with as little as 0% down. VA loans allow members of the military and veterans alike to purchase a home also with as little as 0% down, but don't require any mortgage insurance whatsoever. The third type of financing we're going to cover today is commercial financing. These loans come from lending institutions as well as some private investors or individuals. Loans like this can be used for the purchase of a non-residential property, or maybe a multifamily property that the owner is not going to live in and is only purchasing for the cash flows. These type of loans carry higher interest amounts and also require at least 25% down because the lender making the loan is taking on greater risk by doing so, and they're going to keep it on their books for the cash flow. Under the umbrella of commercial financing, there's 3 different types that we'll touch on briefly. The first is long-term financing, second is hard money, and third is construction financing. Long-term commercial financing is much like the other mortgage loans that we've talked about in this episode, only difference being they mature much sooner. An FHA or a conventional loan might mature in 30 years, but if we talk about commercial financing in long-term loans, those loans typically mature in only 5 to 10 years. Hard money loans typically come from private lenders or individuals lending out their money. Now these type of loans usually carry a very high interest rate, sometimes as high as 18 or 20%, and have very short windows of repayment, maybe 6 or 12 months at the most. These really harsh terms are what give the loans their name, hard money. These loan types are very popular with fix and flip investors who know that they're going to be in a deal for a very short period of time, or those that are just starting out in the real estate development industry and don't have the track record needed to go to a bank or a traditional lender. The third and final type of commercial financing is the construction loan. Construction loans allow you to roll in the cost of building a new building or renovating an existing building into the overall loan, so you only have one single payment to make every month. These loans are of slightly higher risk to the lender, so they do carry a little bit higher interest rate, not quite as high as the hard money, but they're at greater risk because you repaying that loan is so heavily dependent on being able to lease or sell the property as you intended. We've only just scratched the surface of financing in general, but unfortunately that's all we have time for today. If you have any questions on anything we covered in today's episode, or questions about financing in general, drop me a comment below and we'll definitely cover it in a future episode. Thanks so much for watching. Hope you enjoy the rest of your day. Hey guys, Adam Burns here. I'm with my wife Shelby. Like all of you, she has lots of questions about real estate, and we just got done watching the rough edit of our finance options episode, and I think you have some questions for me.
Of course.
Of course.
Always have questions.
What do you got?
So first question is, you talk about different financing, loan options. One of the ones you mentioned is conventional. Mm-hmm. What are the downsides of having a loan or financing option not backed by the government?
Yeah, so conventional financing is not backed by the government. If you have and take conventional financing, the benefit of government backing is really there for the lender. It's not for you as the consumer.
Okay.
So the government backing is there in case you were to default on the loan. They're to step in and basically make it right with the lender. So there's really no downside for you as a consumer to not have a government-backed loan. I think it's actually better because you're able to put down enough to qualify for conventional financing. You don't have to worry about some of the other nuance that goes along with it.
So is it harder to get because lenders might be more enticed to have a government-backed option? Do you have to have certain credit? Are there certain standards in place to be able to get such an option?
There's actually more hoops to jump through when it comes to government-backed loans.
Really?
More check boxes to check and more things that they look into.
Gotcha. So it's not necessarily harder, and will a lot of lenders provide that option to you, or?
Conventional financing?
Yep.
Yeah, most lenders, that's all they provide is conventional financing. It's more niche to actually go out and get an FHA loan or VA loan or USDA loan.
Even though it's potentially riskier for them, the lender?
It's not. So the government backing is there to make it less risky, but not all lenders lend in those avenues.
Gotcha. But you're taking away that government backing, so it would be more risky, right?
No, because you're putting down more money. So
I
by
see.
putting down more money, the lender is at less risk because you're putting down or taking away their risk of default. So because you have a higher percentage of your equity in the property, it's less likely that you're not going to be able to pay back that loan if the property ever had to be sold in foreclosure.
Gotcha. So that's the biggest difference. You need more down with the conventional.
Correct.
Okay. Awesome. Thank you.
Yeah, no problem. What else do you want to ask?
All right. So you mentioned loans can be sold on the secondary market. What happens to my loan if it's sold on the secondary market? Is it no longer my loan? Do my rates change? Does somebody else take over my loan?
Yeah, so nothing changes if your loan gets sold. It's just who is the beneficiary of the interest and the principal payments that you're making. So where your money goes changes, but from the face of it, nothing changes for you. The interest rate doesn't change, the terms of the loan don't change. You might even have the same servicer or the same person that's collecting your monthly payment. That might even stay the same. So there's really no difference to you as the consumer. The thing that changes is the person who is the beneficiary.
Is it a person or is it a bank?
I'm saying person, but it's usually an institution. Like I mentioned in the episode, it's Fannie and Freddie are the two largest consumers of purchased secondary mortgage market loans.
Okay.
But yeah, other institutions do purchase these loans usually in bulk.
Okay, so it just changes hands. So it might go from Fannie to Freddie?
Sure, or something along those lines.
Okay, and there's no additional risk with that happening, or should I be worried because it's changing hands?
It changes nothing for you.
Okay, and can you explain who Fannie and Freddie are so that people don't think that they're our cousins? For those of us that don't know who they are or what they do, give me some context to who Fannie and Freddie are.
I should have had
Or
you
what
ask me
they
these
are.
questions before, because I actually don't know. I mean, they're just government
That's why I was like, do you want to
agencies.
look at them? Yeah.
Good question.
So
So not our
we
aunts
might
and
have to do
uncles.
that all over again. So guys, I guess we actually don't know here exactly who Fannie Mae and Freddie Mac are. So this is a question for you, the viewer. If you can drop me a comment on this video and be the first to tell me exactly who Fannie Mae and Freddie Mac are and their function, I'll give you a $100 Amazon gift card for that accurate answer. But you got to be the first. What else?
All right. Out of the different loan options you mentioned, which one offers the best interest rate?
Best interest rate, meaning the lowest interest rate?
Yeah, or however you would interpret it.
So interest rates are tied a lot to how risky the loan is, or how much perceived risk there is in the loan.
Sure.
So the less risky the loan, the lower the interest rate. So if you have a conventional conforming loan, that's pretty non-risky. So that's going to be kind of the lowest risk out of everything listed.
Okay.
And then the risk continues to go down as you put more money down. So as the bank has less of a position in the deal, the amount of interest actually drops as well. So we talked about putting down at least 20% to get rid of PMI. But if you put down more than 20%, if you put down 30, 40, 50, 60%, you're going to get a much lower interest rate the more money you put down.
Gotcha. Is there one that you tend to choose more than the others?
So I didn't mention in the episode, but we do a lot of construction financing, which is commercial lending.
Okay.
Our rates, as I mentioned in the episode, also are a little bit higher than a traditional conforming loan.
Right.
Usually a point or 1% to 0.5% higher.
Okay.
But yeah, it all depends on the lender and the perceived risk.
Okay. So speaking of risk, have you ever done a hard money loan?
I've not. So I got my start a couple of the other different ways that we talked about in buying our first income property and in that episode, but I thankfully never had to take on hard money.
When would that be a good option for somebody? Like when would somebody choose that?
Yeah,
Because
so
interest rates are typically higher, right?
I mentioned it in the episode, but that's usually like a fix or flip investor, somebody that knows that, all right, I'm going to buy this single family. I have to do the kitchens and the baths. I'm going to be in and out in 3 months. I'll be able to sell it fairly quickly. You know, that might be an opportunity where they're going to pay 18%. But,
Shorter. So shorter term is what I'm hearing.
yeah, so something that's quicker and you have a confidence that you're going to be in and out of the deal in a shorter period of time.
Gotcha. Okay.
The other option is somebody that might be new to the industry and doesn't take our advice on one of the other ways to get into the industry and take the time to build that.
Okay.
People that don't have a track record will typically take hard money for their first few deals to build up that track record.
And who typically lends? Is it an individual, a corporation, a bank? Where can folks find these hard money lenders?
Yeah, there's various ways. A lot of them are individual investors, somebody that lends from their own portfolio because they like the interest rate that they can charge, but there's also corporations and companies that do hard money lending.
Gotcha. Awesome. Thanks for answering that.
Yeah, no problem. Do you have any more questions for me?
I don't. I think you answered them all. Thank you.
All right. Thanks so much. Appreciate you watching, guys. See you next time.